Welcome back to the HMO Property Show with episode 3, and today we're with another person of my A-team. It's Mr. Nitin Vashisht. Nitin, welcome to the podcast.
Thanks, mate. Always good to be with you.
It is a pleasure, as always.
It is.
Now, I'm going to do a disclaimer at the start of this one because we're going to be talking tax, asset management, minimising tax, all the good stuff, but the advice in this podcast is general in nature, not specific to anybody's individual circumstance. If you would like Nitin to provide advice to suit you specifically, you can find his details and his Calendly link in the show notes, and you book some time in and have a one-on-one with him. Now, Nitin, I like it when you say this. There's only two things that are certain in life: death and taxes.
Correct.
You can help us with one of them, yeah?
Absolutely.
You've helped me with a lot of tax, mate. I know that much. One thing I also like is you say you need to treat your property investing like a business.
Absolutely.
And we wouldn't run a business at a loss because we wouldn't last very long, would we? But a lot of people run their property portfolios at a loss. What do you prefer, negative gearing or positive gearing?
Mate, negative gearing means that we are trying to lose $1 to save 40 cents.
Yeah.
And hoping that the future capital gains will be enough to more than pay for our losses. So effectively, you are speculating. You are in the business of speculating, and you're hoping that it will all eventually come good one day. And guess what happens when the interest rate rises or the rental decreases, and interest rates are rising, then it puts more stress on your pocket. And I know a lot of people who will then have to dig deep in their pockets just to keep up with their mortgage. I mean, if I'm very honest with you, Neil, negative gearing is actually a lazy strategy. Because you don't need to do much
Just buy
to make a loss.
Hold.
Buy and hold and make a loss, and maybe saves you a few tax, but you're still overall making a loss, and you're hoping it will all come good one day. So honestly, I'm not a big fan of negative gearing, and like you were saying before, you should be guided always by return on investment. You should treat everything you're doing like a business. I mean, you're out to make a quid.
Yep.
I mean, not to make a loss,
Correct. Well, this is why me and you are friends, mate.
Correct. I mean, I rather prefer people do their homework and do a bit of a research and make their property investments stack up properly based on research, and any capital gains in future, let them be the icing on the cake.
Yeah.
And never let your tax strategy dictate your investment strategy.
I love that one as well.
Your investment strategy must always be guided by return on investment. Of course, tax must be a part of your investment strategy, and the ROI I'm talking about should always be post-tax ROI.
Beautiful. Perfect. Well, this is another one. It's not about how much money you can save, it's how much money you can keep.
Correct.
So we want to make as much money as possible, but then use someone like yourself to help us pay as little tax as possible on
Absolutely,
that.
right.
Using smart tax strategies and smart structures.
Absolutely.
So I want to touch on some of the questions we get quite often from our clients when they're first coming into the business. What ownership structure should I buy a high cash flow HMO property in?
Look, high cash flow property should always, you should buy it in a trust structure where you are able to distribute the gains from that to people who are on a lower tax bracket.
So this is one way that we can minimize tax.
That you can minimize tax. But having said that, I think the trust structures are a lot more than just minimizing tax. You use an ownership structure basically for three purposes you are trying to solve. One is obviously minimize your tax. Second is for better asset protection. And the third is there is an element of estate planning and continuity and transfer of wealth to the next generation in there. And you need to be hitting a sweet spot between all three of them, comparing it with the cost of the structure and making a decision. And I would say always consult your accountant.
Yes.
Before you do.
Before, that's the big thing.
Not after making an offer.
Correct.
It's too late, mate. You've already fired the bullet by that time.
Yeah. Well, we did speak to Elizabeth in episode 2, and we spoke about getting market ready. And market ready means reaching out to the A-team and making sure that what you want to do in property, you are set up to do. It's like a game of chess, isn't it?
Absolutely.
You have to think 3 or 4 moves ahead.
Absolutely.
Yeah. What about HMOs in joint ventures? Can people buy them in joint ventures?
HMOs you can buy in joint ventures. Look, the thing is, there's not much difference between a normal property, investment property, and HMO, except that HMO properties are highly cash flow properties.
Yes.
And they don't make you losses like those negative geared ones. So that is the big difference. Apart from that, you can hold them in your own name. You can hold them in a trust structure. I would never advise them to hold it in a company structure, but you can hold them in a trust structure. And yes, you can do joint ventures. You can do joint ventures through unit trust. You can do partnership of discretionary trust. We can cut it many ways depending upon the circumstances of people who are entering into a joint venture.
Yep. And this all comes in the pre-planning stage before you put the offer in.
Absolutely.
It's critical that it's done before the offer is put in.
My due diligence and being market ready just doesn't mean that the numbers are going to stack up on the property. It's all looking into tax and it's finance and loan and all those things in there.
Yeah. And a lot of people always say to me, is this cost tax deductible? Is this cost tax deductible as well? Like setting up a structure.
Yeah.
All these fees are tax deductible, aren't they?
Well, it depends. It depends whether the ATO sees you as carrying on a business or they see you as carrying on an investment. Now let me explain. Now, any expenses you incur in carrying on in earning an income, you can deduct it. You can either deduct it immediately or you can deduct it like depreciation and like some other capital expenditures over a certain number of years. Now, what happens in case of a structure is that by the time you incur expenditure on structure, the income stream is not there.
Yep.
The income stream will come sometimes in the future. So there is this timing gap. So you're trying to actually claim a deduction for an income that is not yet there.
Yes.
At that stage, you are only hoping income will be there. You really don't even know if the income will be there. So under the general tax concepts, you cannot do that unless there is an exception made in the tax legislation. And the tax legislation, now this type of expenditure is usually called a black hole expenditure. Means it falls in no man's land, So, but exception has been made for this under tax legislation for if you are carrying on a business.
In the business of real estate, not just buying and holding.
So, if you are buying and holding and you are just investing, then this exception has not been made.
Yes, okay.
So, which basically means, so let's say you're going to be developing and you're going to be selling after that, and there is a whole lot of business type way you're handling the things, then yes, you can.
Right.
But if you really are investing, it is to buy and hold, then not. But the thing is, the distinction between whether you are in the business or you're investing is thin. It depends on a whole lot of things, as you know, including intentions and including facts. It's sort of a gray area.
Yeah, okay.
And always take advice before.
Yes. This is why your calendar link is in the bottom of the show notes here as well.
Absolutely.
Just while we're on trust structures and tax deductions, the ATO recently brought out some new rules around trust distributions because, like you say, we can set up a trust and distribute funds out of that trust to people that are on lower tax brackets, partners, kids, dogs, etc. But they recently changed the rulings around this, didn't they?
Actually, as a matter of fact, the law has already been there.
Okay.
It's called Section 100A. It's always been there. But what ATO has done is it has suddenly woken up, and it's come with a very detailed ruling on that how they are going to now treat it. So that is what changes the game. Now, and they're really cracking down on a whole lot of trust distribution over the years, those practices that had become sort of almost like second nature, everyone was doing that. Now, to put it simply, if I just have to explain you the concept of it, because it's a very complex piece of legislation. So if you distribute from a trust to a member on lower tax bracket, and the only reason you are doing that is saving tax, then they consider it as anti-avoidance. and they'll slap you with a penal rate of 49%.
Wow.
But if you're making that distribution under some sort of a genuine family arrangement that is considered to be usually acceptable amongst modern families, and tax savings happen to be incidental to that, then that's fine. Now, let me give you an example. So if the parents who are running the trust, now they have adult kids who are just going to the university. Now, it's very common for a lot of parents to help their kids with the cost of higher education. And the parents decide, now here is the money we are going to distribute from our trust to the kids.
Yep.
So hopefully that pays for their higher education or university fees. It's very costly, or at least reduce that on them. Now that's acceptable. So that's diverting some bit of money to the kids, and if you are saving tax, that's fine. But if you do the same thing to other kid who's going to school, let's say a private school, and you are paying the kids' private school fees, now that's not good.
Okay.
Why? Because that is considered to be the parent's expense.
Right.
Paying for the school fees is considered to be the parent's expense, while the university fees is the expense of your adult child.
Right. So they're really sort of niching down on the example of it.
Correct. So effectively, if you're paying your school's private school fees, you are effectively distributing to yourself because that's your expense.
Yep. So you get taxed at your rate.
Isn't it?
Yeah.
So you get taxed at your rate or at a penal rate if you break the law. So that is really the subtle distinction between that. So, but it's a very complex area. It's newly come out and it's fast evolving. So always I suggest consult your accountant while doing that.
What we do as a business, because we've got the entities that we've got, the trust structures that we've got, we know that when tax time's approaching at the end of June, we reach out to Nitin around the March, April time for
it's always good.
Tax review.
Yeah.
Yeah.
And look, I mean, I'm not saying with these changes, there will not be any avenues of tax planning. There would be. I've given you an example. So I mean, for example, if you have if you have university going kids and you are paying for their education, then don't just take money out from the trust and then pay for their education. Just distribute it from the trust directly to the kids, or rather pay it directly to the university from the trust to be in safer. And other thing that is happening with these changes is you can't make paper distributions anymore. You will have to physically move the money from the trust account to your account or your wife's account or your joint account or the kids or whosoever, and that money cannot find its way back to you, directly or indirectly. If it does, then you're again caught.
That's a big change.
With this provision.
That's a big change.
Now, so which means if you're not physically distributing, you must have solid commercial reasons. Like you're keeping the money in there for cash flow reasons, for working capital reasons, or for pumping it back into or reinvesting into the business.
Right, so we can still distribute it on paper, but keep the money in there if we're using it for cash flow purposes.
If you have a solid commercial reasons.
Right, okay. This all comes back to the tax planning around March, April.
Absolutely, absolutely.
So as an accountant, your busiest time is literally March to October, November. Do you get any rest?
With all these changes happening, I think it's all around the year is a busy time.
Yeah, it is for you, mate, because a lot of my clients become your clients and vice versa, don't they? Because if I'm going to trust any of them with anybody, it's going to be you.
Correct. It's just so important to have that A team, mate,
It is. And you know what? We didn't really touch on your background, did we? We just got straight into it. So I'm going to really just... like, Nitin has been in real estate for what? 14, 15 years?
More than that, mate. More than about 18, 19.
18, 19. You don't look old enough?
No. I mean, I was... and I love real estate, and that's coming from a background, because I've been one of the major CFO and then GM at one of the major home builders and property developers. And I've done... finance, CFO, and all the accounting stuff, looked after contract admin, drafting, estimating, scheduling, a whole lot of these things. So I've got a very end-to-end knowledge of the process, what the builders and what people like you go through.
Yep.
And now also coming for 6 years into my practice and dealing with all the structures and everything.
Yep.
So it's really an end-to-end, and that I think helps me a lot of time in coming up quickly with the structures for people, because a lot of time people know what they're trying to do, but they're just trying to develop and make money. But just a bit of subtle changes make so much difference to tax outcomes.
And I think it's important that, as an accountant, you haven't just done a course and been an accountant. You've been in the trenches with builders and developers, seeing all creative deals. As you say, you were the CFO for one of the biggest builders in Western Australia for a long time.
Correct.
So you've seen a lot.
Not only that, I mean CFO, but I've managed the business.
Yeah, as a GM,
as
a GM, yeah. Wow, incredible. So if you are a property developer, property investor, builder, then this is probably the man that you need to speak to.
Yes.
Because, and as we're talking about building then, so what is better is it better to build a new build, or is it better to buy an established property, do you feel, as an accountant? Let's talk about HMO specifically.
Yeah, I mean, great question. And I think a lot of people sort of toss up this idea. And the reason people are wanting to build, or they are advised to go for a new build, is because you will get a much larger depreciation on a new build. So which means there is more potential of tax savings on a new build. But like I said earlier, when you really are going in for an investment, do a whole due diligence on return on investment.
Yeah.
And not just one tax angle. This is a problem. You see, what really happens is everyone has their angle. So a rep or someone who's selling you a new house will say, go for the new build. You will get this.
Yeah.
Now, it is nice to get this, but you really need to do a more holistic analysis of the return on investment. Maybe you can get a better return on buying up an existing property and renovating it. Let's say refitting it for HMO.
Yep.
And you can get quicker returns.
Yes.
So all I'm saying is, whether you buy a new house or you buy an old house, both will have their own advantages and disadvantages, including return on investment, including the money you will spend on renovating it or building it, including tax outcomes. Just balance all these factors and then make a decision.
Yep.
Don't let anyone throw one dart at you and let you make a decision on that.
Exactly. And this is why we put a plan in place for our clients to buy 4 properties in 10 years. We're thinking about the game of chess. We're thinking 10 years ahead.
Correct.
So we sit them down with you. We sit them down with Elizabeth, and we say, this is what we're trying to do. Yeah. In 10 years, we're going to buy 4 properties.
Yeah.
What structure do they need now?
Yeah.
And what loan does Liz need to apply for?
Fantastic, because it's all need to be scalable as well.
Yes, exactly. If we do a new build, can we claim GST on the build?
Again, you see, GST is applicable if you are in the business, like we spoke earlier. If you are a property investor and you are building just to hold, and you will earn income from rent as a passive investment, then there is no GST.
Yeah.
So there is no point claiming.
Yes.
But if you are, for example, into the business, let's say you are a developer, you have developed few units and you want to sell it, then yes, GST is there and you can claim GST on those builds.
Yep.
But remember one thing, GST is a two-way process. If you are claiming GST credits on the build and onto the progress draws, you will also have to pay GST when you sell them.
Yeah.
Many people get excited, all right, I'll be able to claim this, but you'll have to pay this as well.
Yep.
And guess what? Your sale price, the GST you'll pay on that is going to be much more than the progress and what you claim on the build. But you can always reduce that by using the margin scheme.
Yes.
Never forget the margin scheme.
This needs to be written into the contract, doesn't
Absolutely.
It needs to say we are selling under the margin scheme.
Absolutely.
Yeah. You have come across a lot of developers, or you've actually saved some developers who've come to you early enough you've saved them from paying too much GST and got them selling under the margin scheme and saved them a lot of GST.
Correct.
Do you want to give us the example on one of them?
Look, let's just take the margin scheme. Let's just understand what is the margin scheme. Now, margin scheme effectively is when you're going to be selling a house and it is subject to GST, then effectively you are paying GST on the value add, that is the build portion, but you're paying also GST on the land portion on which you have added no value.
Yes. Yeah.
And And since you would have most likely bought the land from a mom and dad person who's not subject to GST, you did not claim any GST credits on land because there was none. So what the margin scheme basically does is it lets you not pay the GST on the land component. So you're really paying GST on the value added component. But to be able to do that, you must get your buyer to commit in the offer and acceptance that he is agreeing to that, which basically means he is effectively undertaking that he will not claim any GST credits on land himself. It is just the ATO's way to prevent double dipping.
And if he's just an investor or a mum and dad or someone buying the principal place of residence, then the likelihood of that happening are very slim anyway.
Correct.
Yeah, so it's only if another developer buys it, really.
Correct.
Yeah, cool. Depreciation. How does depreciation work when we've got a new build property, and how does it work when we've got an established property that we renovate?
Great question. And it's really a great question, because while there is no difference in the way the GST works on whether you own the property in your own name or in a structure, but there can potentially be a great outcome in the tax for you, even though they are treated exactly the same. And the reason is depreciation can often result in a loss. Depreciation is the money, because a lot of people get confused what is depreciation. I mean, so you can deduct expenses that you're paying for in cash. Now, depreciation is something you are not paying for now, but you already paid for it in a way in terms of buying the house. And you get a deduction written off over 40 years. So it's a non-cash expense in a way. And a lot of time, it's the depreciation is 14,000, 15,000. If it's a new house, for example, then it can result in a loss. Now, if in that case it is in a structure, that loss will have to remain in the structure. And there's nothing, you can't distribute the loss. Yes. You can only distribute the profit.
Yeah.
But if it is in your name, then you can actually take that loss in your tax return, write it off against your salary and your other income, and reduce your tax, which is actually what negative gearing is.
Yes. Yeah.
You know?
Yep.
So while the depreciation is treated as the same way, the outcome can be different. And again, it goes to the due diligence and structuring before you put an offer onto the property, is that if it is negatively geared, do not own it in a structure. Own it in your own name.
Yes.
I mean, the first thing is, don't go for a property. That's going to make you a loss.
Yeah.
But for goodness heavens, if you go for it, do it in your name.
Do it in your own name.
Because that will soften the blow a bit.
Yeah, absolutely. Love that. What about tax deductions? There's a lot of things we can claim tax deductions on real estate, isn't there? Can you give us top 5?
Well, look, you can claim interest. You can claim like depreciation we spoke about.
Yeah.
You can claim your management agent fees. You can claim your repair and maintenance and gardening, or literally your council rates, or any other expense you make in terms of earning that income.
Right. So anything that's got a cost associated with it, you can claim. There's a tax depreciation.
Correct.
Tax rate, yeah.
But these days you're not allowed to come, and you can't say that I traveled to that property or I flew to that property for that matter, just to check on it, and I'll claim that. Now the ATO has disallowed that.
Yeah. Just on the depreciation thing as well, it just sprang to mind there that if you claim depreciation on a property, it gets added to the capital base of that property, doesn't it? So if we claim $50,000 in depreciation from that property and then sell it 5 years later, we actually have to pay that $50,000 back to the ATO.
Correct. It gets clawed back as well. So sometimes that negatively geared turns out to be a big false economy.
Yes.
You see?
What a little scam that is from the government. It's beautiful, isn't it? We'll give you money, but if you sell it, we want it back.
Correct.
Yeah. And they essentially give you money so you can reinvest that back into more properties.
Correct. I mean, it's a great marketing tool used by some. I mean, there is arguably some cash flow benefits in terms of tax, a little bit upfront, but really it's a big sucker in my view.
Absolutely. And again, mate, this is why we're such good friends and we do so much work together, because we're both on the same page.
Absolutely enjoy it, right?
Finding an accountant like you is very hard, mate. And when I did find you, I was like, yes. If I sell my investment property, do I pay capital gain tax?
Of course, you do. But to be honest with you, it's not a bad thing, because that means you're making money.
Yes.
And you're alive and kicking.
So paying tax is a good thing.
Yeah, so paying tax is a good thing, but paying even $1 more than that is necessary is stupid. That you should not do.
Yes.
How
do we do that?
So paying taxes is not a bad thing. Like sometimes I always say, the best doctors in the world, Neil, are those doctors who conduct postmortems. You know why? Their patients never complain. So paying tax is a good thing. It means you're alive and kicking. And unlike negative gear, where you're making loss, it means you're paying a profit.
Yep.
But plan your efforts well, so you pay as less as possible. And like I said, there are many strategies. Structure is one strategy. And there can be many other strategies like trust structures and other things to be able to reduce that.
Yeah. I actually look forward to the day that I pay tax on $1 million, because that means I've earned some really good money and you've worked your magic, and it means I'm still getting taxed on $1 million. So it is a good thing. And there's only two things in life which are certain. You're going to pay tax. You cannot avoid it. Can you? So you might as well earn as much money as you can and just try and minimise it as much as you can. If I sell my principal place of residence, do I have to pay capital gain tax?
No, you don't.
Right, okay.
No, you don't, because your principal place of residence is totally outside the tax net. So it's totally tax-free, provided it's your principal place of residence. But if your principal, I've seen people, just because of asset protection reason, anything in your own name is not really a good thing from an asset protection point of view. So a lot of people will hold it in a trust, and so what really happens in that case, you lose your principal place of residence exemption. But as long as your principal place of residence is in your name, you sell it, make whatever income you want. Australia is pretty unique in that way.
Good.
So it's totally outside the tax net. You pay zero tax.
So can I buy a block of land in my own name and develop it and say that it's my principal place of residence?
If you're developing, then it's not, because you've got to be living in it consistent with being your principal place of residence. You don't live on an empty land. You can't put a tent on a land and say, Neil, that I'm camping and it's my principal place of residence.
Yeah. So what is the definition of a principal place of residence?
Look, there is no particular definition, or there is no particular sort of a time frame you have to live into it. All it says is you have to be living it in there consistently in a manner that a normal family would consider as their principal place of residence. Now, what that means is the post should be coming in there, your electrical connections, your phone connections should be in that name, And so while no one particular is there, they look at it holistically.
And how long do I need to live in a house for it to be my principal place of residence?
I would say, again, like I said, there is no sort of a set length of time. As long as you're living it consistently like that, look, even after 1 month, some shit could happen and your circumstances could change, and probably that would be good enough.
Yeah.
But as a rule of thumb, in normal course, you say at least 6 months.
Yep, great. Awesome. If I draw equity from my portfolio, let's say I buy a property for $500,000, it goes up to $800,000, and I redraw some of that money back out, do I need to pay tax on that redraw?
No.
Perfect.
No. You pay tax on income. The equity you're drawing is not income.
Right.
Your equity becomes income if you sell your property.
Okay.
If you sell your property, that's when your equity becomes your income and you pay tax on it. But till the time you have sold it and it is still yours, so it's just a valuation and this is the equity and you're drawing on it based on valuation, then there is no income.
Interesting.
But if you put that equity to use in terms of making an investment and make money from that investment, so that income will be taxable.
So this is the game. We buy a property, we make sure it's cash flow positive, we wait till it goes up in value, we redraw on that equity.
Correct.
Buy another property, we make sure that one's cash flow positive.
Correct.
We then have 2 properties that
Absolutely.
go up in value, we leverage off them too.
Absolutely. And you see, the good thing is the property is cash positive. It will be self-sufficient.
Perfect.
You won't have to keep putting in money to keep it going, isn't it?
Yeah, exactly. Do I have to pay tax on my cash flow from my HMO?
Of course, yes.
Yeah.
And again, that's a good thing because HMO makes you money, so you'll have to pay tax.
Yep.
And HMOs that we've spoken about, they're very high cash positive properties. But you obviously can reduce that, by claiming deductions like depreciation. That will reduce your tax.
Yes. And it all comes back to the structure, which all comes back to the planning.
And with the structure, you can again reduce that tax even further through a smart structuring.
Yes.
Yeah.
Perfect. Couple of last questions, Nitin, because we're running out of time. Can I buy a HMO in my self-managed super fund?
I think HMO, yes, you can buy in your self-managed super fund, especially when the HMO is an existing property.
Mm-hmm. So we can't do house and land packs in our self-managed super?
It gets a little bit tricky. If you're doing it in super, if it's an existing property, it's a no-brainer. You can buy that because you're like holding for rent and for passive income. Yeah. Now, in terms of a house and land package, or in terms of subdivisions and development and all that, now there is nothing in the legislation, Neil, that says that you can't develop and you can't do this and that. So, but they control it indirectly, because a self-managed super fund is supposed to be in existence with the sole purpose of providing for retirement of a person.
Okay.
And that is the whole idea of a self-managed super fund. The moment you start doing a little bit riskier, a little bit those type of activities and subdividing, because what's happening is really when you're subdividing, so for a year or 2 years, till the time a new asset comes into the place, you have destroyed that asset.
Yep, I'm with you.
You understand?
Yeah.
So what happens if someone dies tomorrow, or needs some money tomorrow, or there is an issue, or is retiring, especially if they're older. So it gets a lot more complicated there, but there is an indirect way to do that. So, but a self-managed super fund can invest always in a unit trust that is doing some property subdivisions.
Right. Okay. So ideally, if we were holding a HMO in our self-managed super, it would need to be on one contract.
Correct.
Yeah. Okay. And then we can use additional money.
Once that is built, then you can buy it.
Yes.
But it really becomes complicated that if you are going to be getting into a contract and start shelling money out from a SMSF today, for you to acquire that asset 2 years later.
Yes.
But once it is done and built, then you can acquire.
Okay. So the game is to get somebody else to build it, and then you buy it once it's built.
Correct. But I always say, but you can do things through a unit trust if you're doing subdivisions and all that, but it's a complex area. So I'll encourage everyone to seek advice from their accountants and do things very carefully in a considered way under advice.
Yes. Brilliant. Last question: can we develop property in our self-managed super fund?
I think we just discussed that.
So we can invest into a unit, somebody else's unit trust that can develop property. Yeah.
Or you can be the unit holders.
Yeah. Okay. Great. It's a very.
You can create another trust that can be a unit holder.
Yeah.
In there. There is a particular way to do that. So that's why I say do it under advice. Not just go there. I buy a unit trust of internet somewhere and
definitely do not do that.
Yeah,
definitely do not do that.
Not for this.
No, not for anything. For the addition, for the cost that it is, for any project that you're doing, the cost of setting up a trust is the cost of setting up a trust, and it should be done by professionals, not off the internet.
That's it.
Yeah. Nitin, again, mate, it's been an absolute pleasure as always.
Thanks, mate.
And because this is such a specialist area and the landscape is constantly changing, we're going to have to do this again in a couple of months' time.
Not at all, mate. Always a pleasure to come back and speak to you.
Brilliant. Thank you, mate.
Thanks, Neil.
And I'm going to leave you with this quote: knowledge is not power. Execution of knowledge is power.
Absolutely, mate. Absolutely. Absolutely. Power in the wrong hands is a very destructive tool.